the heart of global finance, a scandal unfolded, threatening the stability of world economies. The LIBOR scandal exposed banks rigging interest rates, affecting trillions in loans worldwide. Wild. LIBOR stands for London Interbank Offered Rate, a benchmark rate set daily. It influences everything from mortgages to student loans, making it a linchpin of the financial system. Banks reported their borrowing costs to set LIBOR. But in a web of deceit, some banks manipulated these reports for profit, distorting financial markets. This manipulation affected millions of borrowers and savers, revealing deep flaws in banking oversight and the global financial architecture. The scandal began to unravel when whistleblowers alerted regulators, leading to investigations that uncovered widespread misconduct across major financial institutions. Regulators launched probes into the practices of banks like Barclays, UBS, and others, seeking evidence of collusion and fraud in setting LIBOR rates. As the investigation deepened, it became clear that the manipulation went beyond one institution, implicating numerous banks globally. This widespread manipulation not only affected financial markets, but also eroded trust in the integrity of banks and the entire financial system. The consequences were severe, leading to billions in fines and significant reforms in how financial benchmarks are calculated and monitored. Banks manipulated LIBOR rates to appear healthier than they were, masking their financial weaknesses during the global economic crisis. This unethical practice misled investors and regulators alike. LIBOR rates influenced trillions of dollars in loans worldwide, including mortgages and credit cards. Banks' manipulation artificially lowered borrowing costs for themselves and others. The scandal came to light when whistleblowers and regulatory bodies discovered irregularities in reported interest rates, prompting investigations into banks' practices. Regulators found evidence that traders at major banks colluded to manipulate LIBOR rates, affecting not just their own profits, but those of countless other institutions. These manipulations distorted market signals, leading to mispriced assets and contracts tied to LIBOR. Investors and consumers suffered losses due to this deceit. Major banks like Barclays, UBS, and Rabobank faced scrutiny. Regulatory bodies demanded transparency and compliance, initiating a series of lawsuits and settlements. Barclays was among the first to admit wrongdoing, paying billions in fines. Their confession revealed an industry-wide culture of manipulation and deceit. UBS faced similar charges, admitting to manipulating LIBOR rates for years. Their actions exemplified how widespread the fraud had become. Rabobank, a Dutch bank, also confessed to involvement in the scandal, highlighting the international scope of the manipulation across major financial markets. The impact of the scandal extended beyond financial institutions. Consumers saw higher costs on their loans and credit products due to these manipulations. Governments around the world took action, implementing stricter regulations to prevent future manipulations. These changes aim to restore trust in financial markets. Reforms included more rigorous oversight of LIBOR reporting and the introduction of alternative benchmark rates, such as LIBOR in the United States. SOFR, the Secured Overnight Financing Rate, aims to provide a more transparent and robust alternative to LIBOR, based on actual transactions in the overnight Treasury repurchase market. Despite these reforms, the legacy of the LIBOR scandal remains. Financial institutions continue to face scrutiny and must adapt to new regulatory landscapes. The LIBOR scandal exposed deep-rooted issues within the banking sector, highlighting the need for ongoing vigilance and ethical standards to maintain trust in financial systems. Transparency and accountability became key priorities following the scandal. Banks were required to improve internal controls and comply with stringent regulatory requirements. In addition to regulatory measures, the scandal prompted a broader discussion on ethical behavior in finance. Industry leaders emphasized the importance of integrity in financial practices. The LIBOR scandal also led to increased collaboration between national and international regulatory bodies to ensure coordinated efforts in monitoring and preventing market abuses. As LIBOR phases out, financial markets transition to newer benchmarks like SOFR. This shift aims to create a more reliable and transparent system for determining interest rates. The transition to new benchmarks involves complex legal and financial adjustments. Institutions must adapt quickly to avoid disruptions in their operations and client services. Consumers benefit from these changes as well. More accurate and transparent benchmark rates can lead to fairer pricing of financial products and services, reducing hidden costs. The LIBOR scandal has underscored the critical role of regulatory oversight in maintaining the integrity of financial markets. It serves as a reminder of the potential consequences of unethical practices. Despite the progress made in reforming financial markets, the LIBOR scandal continues to shape discussions on ethics and regulation. Its lessons remain relevant for the industry. Ultimately, the LIBOR scandal highlighted the need for continuous improvement in financial systems. It prompts ongoing dialogue on how to better protect consumers and uphold ethical standards. The scandal exposed widespread manipulation within financial institutions, leading to global regulatory crackdowns. Banks faced billions in fines, but many executives escaped serious punishment, sparking debates on corporate accountability. LIBOR rates influenced trillions of dollars in loans and financial products worldwide. Manipulation meant consumers paid higher interest rates, while banks profited from the artificially low reported rates. Reforms aimed at transparency included replacing LIBOR with more reliable benchmarks. The transition was complex, involving coordination across different countries and financial systems to ensure stability. Despite reforms, questions remain about the resilience of financial markets. The LIBOR scandal underscored the need for ongoing scrutiny and vigilance to prevent future manipulations and protect investors. In the aftermath of the LIBOR scandal, global regulators worked tirelessly to prevent future market manipulation. New benchmarks were introduced, aiming to ensure transparency and fairness. However, the financial system remains complex, with countless interconnected variables that can be exploited by those seeking advantage. Vigilance is key to maintaining integrity. The LIBOR scandal highlighted the need for stronger oversight and accountability in financial institutions. Regulators must stay ahead of potential risks. While reforms have been implemented, it's crucial for consumers and investors to remain informed about how their money is being used and managed. Education and awareness play vital roles in safeguarding against future scandals. Knowledge empowers individuals to make informed decisions. The LIBOR scandal serves as a stark reminder of the importance of ethical standards in finance. Every participant has a role in maintaining trust. Transparency in financial transactions is not just beneficial, it is essential for the stability and growth of economies worldwide. By demanding transparency and supporting robust regulatory frameworks, we can work towards a more trustworthy and resilient financial future. Let us all strive to understand and advocate for fair practices, ensuring our financial systems serve everyone, not just a few. Together, we can build a future where financial integrity is not just an ideal, but a reality, benefiting all members of society. Thank you for watching. Remember, staying informed and advocating for transparency are crucial steps toward a better financial world.